Welcome to ForexTV.com's PM Exchange. It's Friday, January 25th. I'm Remy Hokie. Today I'm joined by Michael Woolfolk from the Bank of New York Mellon. Good afternoon, Michael.
Yes, good afternoon, Remy.
Thanks for joining us on this Friday afternoon.
Thank you again for inviting me.
Well, it's been quite a volatile week in the markets. We started out seeing all the global equities around the world take a nosedive, and we started the holiday shortened week with a Fed rate cut, both in the discount as well as the Fed funds rate. So looking ahead to next week, we have a lot on tap. So for Forex traders out there, what should they be keeping an eye on?
Wow, that's a tall order, Remy. It was quite a volatile week. We had quite a steep sell-off on Monday. Keep in mind, Monday was a U.S. holiday. And as many of your viewers are aware, there was some losses posted by a European bank, and many of those losses were transacted, were squared up on Monday amidst a very thin market condition. So what we saw was a very, very steep sell-off in global equities, with many market players wondering what was behind it, for fear of that this was more of a market panic, a loss of confidence in the market. The Fed apparently was unaware of this, this particular bank's problems, and also assumed that there was a lack of confidence in the market and they needed to do something immediately. Hence the 75 basis points intermediate cut on Tuesday morning. It had the intended effect, which was to reballast the market. And we saw quite a correction that afternoon. Wednesday, the news came out about it, that this caused yet a further rebound, and I think at that point, the dollar, which had gained ground as the equities had sold off on safe haven capital flight, I think that as equity markets stabilized further and rebounded, the dollar came under some pressure. That pressure was exacerbated, particularly against the euro, when ECB Council member Axel Weber came out and said that in response to a question about prospects for the ECB cutting rates, that was wishful thinking. I think really underscoring the fact that Trichet had some support on the ECB Council that they would not be cutting interest rates anytime soon. So that is viewed as supportive for the euro, with the Fed cutting and the ECB on hold, perhaps even considering a rate hike at some point. Interest rate differentials continue to weigh against the dollar. The rebound that we've seen in the market continued into today's action, and the yen has come under some pressure as global investors went back to the yen for borrowing and investing in these equity markets, commodities, and other high yielders. Next week we have a very heavy calendar. You know, we had a heavy calendar last week, we had kind of a timeout this week in terms of data, and next week very heavy. We come right out of the gates with consumer confidence. That's a January figure, and kind of the leading edge of the January data. And I think what's interesting there is you'll probably see something a bit weaker than market expectations, but still, given the panic that we've seen, still a very reasonable number, probably about an 85 index, down from roughly about 87.5 or 88 previous month. Certainly not denoting any type of market panic, just the drop in the stock market.
Well, Michael, you did mention next week, and almost every other day next week on the calendar front, we do have major events. On Monday, we have President Bush's State of the Union, and on Wednesday, we have the official FOMC rate announcement.
Right.
And I think a lot of people are forgetting about non-farm payrolls since it is at the end of the week, but it will probably be another major focus in the market. So if you could briefly give us your expectations for both the Fed rate announcement as well as non-farm payrolls and unemployment.
Sure. I mean, certainly the center in the U.S. in terms of the economic calendar is the FOMC decision. It's a two-day meeting, Tuesday and Wednesday, so the decision is going to be in the afternoon on Wednesday. The market, I think, maybe is a little ahead of themselves in expecting the Fed to cut 50 basis points. The reason is that the 75 basis point cut that we got this week was probably intended for next week at the meeting. So to what degree should they continue cutting? Certainly further easing is in store, but they have to be careful of doing it too quickly. I think 50 basis points would probably be something of a policy mistake, and staying on hold would be a policy mistake. What we think a 75% chance of a 25 basis point cut, with the remaining possibility of 50 basis point cut. Now, probably the second most important thing on the agenda for next week actually is going to be GDP in the way I look at it. That's going to be our first estimate of fourth quarter GDP. For each of the last 3 quarters, we've been anticipating negativity. We're still waiting for that soft patch to arrive in growth. We're anticipating 1.3%, which is not far off of market expectations, annualized growth. That should be relatively supportive for the dollar and for fundamentals looking forward. Then probably the third most important event will be non-farm payrolls, of course. The market is pricing in about a 50,000 job increase. It's a January figure. We're a little bit more optimistic. We think about 100,000 jobs. We had, I believe, 18,000 the previous month, not a particularly good number at all. And we think that with the initial jobless claims, the weekly data that we've been seeing recently, surprising in terms of the strength of the figures, that will carry through over into non-farm payrolls. We'll get an ADP on Wednesday, which will give us some leading indication, hopefully. If that continues, that relationship continues to hold up, ADP might give us a better estimate of what to expect on Friday. Personal income and spending is always important for us on Thursday. Nothing out of the ordinary. My personal income at 0.4%, and spending maybe about flat to 0.1%. Durable goods, I think we're going to have a good number. The headline should be supported by aircraft orders. So look at something in the order of about 1 to 1.5%. So generally, the week will be relatively supportive for the dollar because it will not highlight any crisis conditions emerging. We'll see continued moderating of U.S. growth conditions, but nothing a red flag in terms of a recession. So we're looking for the euro dollar to hover maybe in the area of about 145.50 to 148.50 or so.
Okay, well, one question I have for you, since we just mentioned euro dollar, is that given rate expectations, rate differential expectations for both the Fed and the ECB, we haven't seen euro dollar retest a record high that was hit November of last year. And in the afternoon session, we saw euro dollar pull back under 147. So can you give us your take on why we haven't seen euro dollar retest record highs?
Well, it's the value of the dollar is something like a tug-of-war contest. That there are many pressures offsetting one another. We know that typically in the first 2 or 3 weeks of January, there is a January effect where global reallocation, global investor activity tends to favor the U.S. dollar and dollar-denominated assets. So I think that maybe some of the dollar's underlying strength we've been seeing recently, in part, is that January effect. And I think in addition, and perhaps more significant during the early part of this week, has been safe haven capital flight into our deposits and short-dated CDs and whatnot, perhaps even into our bond market. And that is in the process of unwinding as we speak, and that's where you're getting a little bit of the weakness. I think interest rate expectations about the Fed continuing to cut next week, and the ECB making it very clear once again that they're not intending to do so. I think the expectations are for the speculators to continue to build on their long euro dollar positions. So I think that's kind of where we are right now. I'm not going to say that the economic data out next week is going to be unimportant. I just think it'll probably take a backseat to the FOMC.
Okay, and if we could take a look at dollar yen, since we're talking about safe haven investing. This week we saw U.S. equities move in and out of positive territory, and in late afternoon New York trading, we're seeing the Dow and the other major indexes back down in the red. So given this volatility, we've seen dollar yen and the yen crosses under pressure. But for the near term, where do you expect the yen to head?
Well, against the dollar, we're expecting it to stay within about 106.50 to 109. I think that in general, dollar yen is probably going to be edging closer to the 110 level, particularly as we're assuming that these markets continue to correct, continue to rebound. Against the euro, we see the yen again staying in a range of maybe 156 to 160, reflecting euro strength and yen weakness. The euro is expected to benefit not only from interest rate differentials as they look increasingly hawkish, but the negative on the yen side would be continued yen borrowing, carry trade borrowing.
Okay, and last but not least, if we could take a look at the sterling. In today's session, we saw the sterling edge higher against the U.S. dollar, and some analysts and strategists, they've been talking about the pair retesting the $2 mark. But what's your outlook for the sterling, both in the near term and long term?
Right. Well, I think near term there might be a little bit of upside potential left. The dollar is coming under some pressure. It's clear that the Fed will be more aggressive in cutting interest rates than the Bank of England. And it also seems pretty clear that the pace of economic slowing will be greater in the U.S. than in the U.K. So I think that anticipation of cable crashing down to 190 or even below 190 is very premature. I think there's a healthy correction. So we're looking at a range maybe 195 to 199. 200 just seems like a tough nut to crack at this point. I mean, you're with the BoE easing, that's going to be quite a challenge. I'd be surprised if we saw that within the next several trading sessions. And in terms of the performance, the sterling versus the euro, I think we're probably headed back over the 75 pence mark, so maybe 0.74 in the euro sterling cross, up as high as maybe 0.7550 or thereabouts.
Okay, Michael, as always, thank you very much for coming on the show.
Okay, well, thank you very much for inviting me.
Thank you. This has been your Forex News with Michael Woolfolk from the Bank of New York Mellon. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended a volatile week in the red. In another seesaw session, the Dow ended lower by 170 points after gaining over 100 in early trading. The blue chip index gained a mere 0.9% on the week. Market jitters were evident, especially over the possibility of additional write-downs from the major European banks. Also, short covering and lack of buying interest added to the late session decline. At the closing bell, the Dow Jones Industrial Average fell 171.44 points, or 1.38%, to end at 12,207.17. The tech-heavy Nasdaq fell 34.72, or 1.47%, to 2,326.20. And the S&P 500 fell 21.46, or 1.59%, to 1330.61. In the fixed income market, U.S. Treasury bonds advanced as equities declined in the session. The benchmark 10-year note rose with its yield falling 13 basis points to 3.58%. The 30-year bond also advanced with a yield of 4.32%, down from 4.37 late yesterday. And the 2-year note gained with its yield at 2.26% from 2.32% late Thursday. In energy, crude oil futures advanced for the second straight session, closing above $90 a barrel. The benchmark contract hit an intraday high of $91.38 a barrel. March crude ended the session up $1.30 or 1.5% at $90.71 a barrel on the NYMEX. Crude gained nearly 3% in the previous session. For the week, the benchmark crude contract added 79 cents a barrel. Taking a look at other petroleum products, February RBOB gasoline added 3.54 cents to close at $2.3182 a gallon. February heating oil added 4.28 cents to $2.5191 a gallon. Meanwhile, February nat gas futures added 18.1 cents to close at $7.0983 per million BTU. Over in metals, gold and platinum futures hit new record highs on the day. The precious metals soared as both geopolitical and safe haven concerns added to gains for the metals. Due to power shortages at major mining companies in South Africa, operations were shut down at the world's second largest gold producer and the world's largest platinum producer. February gold hit a record high of $924.30 an ounce in electronic trading on the NYMEX. February gold added $4.90 to end the session at $910.70 an ounce. Meanwhile, March silver rose 15.7 cents to close at $16.49 an ounce. March copper gained 1.25 cents, ending at $3.1840 a pound. March palladium rose $9.40 to end the session at $385.45 an ounce. This afternoon, we're joined by Derek Fry from ONF Futures and Options. He'll recap this week's action in energy and metals and also give us his outlook ahead of the weekend.
Okay, recapping the action that we saw this week in the metal and energy sectors. I'll start with the metals. We got the all-time highest print in gold, just a hair under $9.25, $925 an ounce today. We were unable to maintain that price. I mentioned last time when we saw the gold push through 900 that we saw what we typically refer to as demand destruction, and we're seeing that again up here. So I don't, for at least the short term, we don't believe that we're going to be able to maintain above 900 very much next week. So we are looking for a pullback, like I said, below 900. We could see a retest of the 850 lows that we saw just a couple of weeks ago. So there's definitely a chance of that again. And basically, more or less, a new range-bound market here developing. I think between about 850 and 9.25 now will be the range for the foreseeable future. But bottom line is we put on some short positions today near the highs above 900, actually above 910. So we'll, like I said, look for a correction back below 900 into and through next week. Moving over to energy real quick, crude oil pretty much held the line today around $90. Ended up there. And we mentioned that we thought 85 would hold in past comments, and we've seen that now and mentioned it in our newsletter as well. And 85 has held as we expected. At this stage, we do expect to see the mid to high 90s tested this quarter, if not in the month of February, certainly by the end of the quarter, and ultimately probably retest the highs, the 100 level again. So, we continue to be happy buyers anywhere below 90, ultimately with stops below 85.
That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us Monday morning for your latest news update right here on ForexTV.com. Have a great weekend.